Hi, I'm Marko Kurek, and this presentation was put together alongside Vincent, and it'll be about the new accounting rules regarding leases, especially for international companies. So a brief summary of the article is the rules regarding the reporting of leases on financial statements have changed for international companies. It used to be that leases could be reported in the footnotes section of the financial statements. Now, however, they're reported on the balance sheet as assets and liabilities. Problems arise because now that leases are going to affect assets and liabilities, some ratios may appear skewed compared to what they may have been in previous years. Managers are now implementing new performance measures to make the financial statements appear more fluid than they would have if they had been completely left alone. So, if you were to implement this new rule and take no precautionary measures to make sure that financial statements are fluid, as we'll go into in future slides, it would really skew some ratios, some performance measures, and so managers now have to take into account these new rules to make all the financial statements kind of line up better. So the key issues from the financial statement analysis perspective. The main issue is certain aspects of the financial statements may appear to be weaker or stronger due to the addition of leases on the balance sheet. One of the largest concerns is the spike in free cash flows. If investors see that a company has more cash left over after expenses, the company's reports will appear much more attractive than they actually are. Leverage ratios are a component that investors use to analyze the risk associated with a company and their ability to pay off debt. Weaker leverage ratios could turn away investors because the company may appear to have more trouble paying off their debts than they actually do. Earnings per share is another gauge that investors use to determine companies' profitability. Weaker earnings per share can make investors feel the company is becoming less profitable. And all the aspects pretty much that are going to be affected by this new rule are aspects that are going to appear stronger would be earnings before interest, taxes, depreciation and amortization, and higher free cash flows. Aspects that may appear weaker would be leverage ratios and earnings per share measures. And this is a big problem if it's important that these managers are doing what they're doing, because things like all these earnings reports and higher free cash flows, leverage ratios, these are kind of like some of the main ratios and aspects that investors look into in financial statements. And if they were skewed for the weaker or stronger than they were in previous years, it would really affect how investors view the company and their ability to invest in it. So what step does this affect? The step in the financial statement analysis that this affects is the investor's ability to make future predictions based on past financial data. If a company has had, let's say we're 5 years in the future now, right? And if a company has had 3 years of increased earnings per share and increased profitability, then this change happens. So now it appears as though the past 2 years their earnings per share and profitability have been in a slump. Their ability to pay off debts does not appear as attractive, or the other way around, their free cash flows have skyrocketed. Investors could either be less likely or more likely now to purchase stocks, bonds, any security that the company has to offer based on these change in ratios. So now, what does it mean to the company? What this means for the company is companies will now have to take measures to assure that a change in reporting standards does not skew company performance appearance to investors. These changes will also make it more difficult for current shareholders to compare past results to current performance and judge the success of the company's strategies. One company, for example, that's putting in some managerial precautions and metrics to ensure that these financial statements aren't skewed is a Paris-based company known as Orange. So they're going to replace earnings before interest, tax, and depreciation and amortization with earnings before interest, tax, depreciation, amortization, and leases to reflect the company's large number of leases and how the payments associated with them will affect earnings. So this is a really good thing because now their earnings it's going to be earnings before the lease expenses. So if they have a lot of properties that they lease and buildings that they lease for offices, now they're going to be able to show to other companies and investors that they're really not incurring all these earnings or all these expenses, and they're not going to have all this leftover earnings. They're actually going to incur these expenses with the leases, or the other way around, properties that they're leasing off, they're going to be able to show now that they're making money off these leases rather than just throwing it kind of in the footnote section. So how will this affect us? So most of the people in this class obviously are accounting majors, a bunch of us are finance minors, and it's important for us to understand the rules of international reporting in case we find ourselves maybe working for one of these companies in the future or potentially investing in one of these companies in the future. So from the accounting perspective, we need to be able to present the financial statements in a manner that will provide a fluid analysis experience for potential investors. And to make it as easy as possible for them to compare statements, whether it be past, present, and honestly give them a good ability to extrapolate on our financial statements and be able to make assumptions for the future of the company, because that's really what most investors do prior to investing. From the finance perspective, it's really important that we understand these rules and how they're gonna how the implementation of these rules is going to skew financial statements. And we need to look out for companies that they don't take all these precautionary measures, because a company that doesn't have a great management and isn't taking all these measures to make sure earnings don't look skewed, liquidity ratios don't look skewed, we need to be able to kind of dive deeper into the statements and not just look at earnings per share, look at liquidity ratios, and then judge just from those that, oh, this is a good company to invest in, or, oh, their liquidity and EPS has dropped in the past few years, so they must be doing poorly. We need to really dive deeper into these financial statements and know these rules to know that, oh, so in 2019, their earnings per share and their liquidity ratios dropped, but that may not necessarily be a bad thing. It's just the addition of leases on the balance sheet. So that's all for the presentation. Thank you for watching.